that when everybody else is panicking, that's when the savvy investors move in. That's where people who know that their life is not affected by down markets move in to buy things on sale and seize on opportunity.
Right. Hello, Peter. Good to see you. Welcome back, everyone. We have 4 signs that you might be taking on too much risk. This is fun to talk about, Peter, because risk, of course, isn't just about the numbers. It's about how you feel when those market conditions change. So let's talk through some signs that you may be taking on more risk than you should. First, you check your accounts constantly, but how often is too often?
I mean, if you're on there daily, weekly, you gotta know if you see red in the charts on the stock report or hear the markets day and immediate down today and immediately go and jump and check balances.
Mm,
We may need to do a pulse check on that,
yeah,
because everybody enjoys the market when it's moving up. But if you're constantly worried that, oh no, I'm going to lose something that is essentially essential to my life. I mean, money is math, right? It's numbers, but it's also mental, emotional, psychological. The
very
number
much.
one cause of divorce is financial. The number one cause of death, or I don't know if it's number one, but it's high, is stress. And money can lead to this side of things. So people make a lot of mistakes with their money because of emotion as well. So yeah, if you are constantly hovering and helicoptering and just pulse checking your account balances, you probably know that you're taking on too much risk. And oh, by the way, like the market has been moving up. Again, something we've all appreciated, but that has also led to the at-risk accounts growing, which means even more of your money is probably at risk than it
Right.
was 2 or 3 or 4 years ago. So yeah, we need to just make sure that things stay in alignment as we move along in
Mhm,
life.
mhm. All right, sign number 2, you need to ask yourself, do you lose sleep when the market drops? It is, though, hard, Peter, to keep those headlines out of our brains.
Uh, if you could put the blinders on with investing, it might be the best thing for a lot
Yeah,
of people. Like just kind of tune it out. You are working for your paycheck during your income earning years. Not only are you supporting your ability to pay your bills, but you are also the gasoline in the engine for your investment portfolio. And the direction of your money matters as much, if not more, than the direction of the market during those paycheck earning years. You are dollar cost averaging in, and your lifestyle does not depend on the day-to-day movement of the market now or anytime in the near foreseeable future. You kind of need to just make those investments, set it up at a good allocation, and then do your job, do your work, earn your paycheck, make the investing as automatic and often and as much as possible, but don't even pay attention to it. And that actually can be a beneficial approach for a majority of our investment lifespan, Erin.
yeah, yeah. An analogy that I liked is your portfolio is like a bar of soap. The more you touch it, the smaller it gets.
Yeah, yeah, and oftentimes people are constantly in tinkering, and
Right.
we do the wrong thing at the wrong time, the wrong way, and don't have as much at the end of the day.
Mhm. All right, sign number 3 is you've made panic-driven decisions before. So we have talked about this, Peter, many, many times. You touched on it a second ago. Emotional investing. Explain what's happening here.
Yeah, well, again, your money is very much tied to your emotion and vice versa. There is an old chart, and as you see it on the screen here, it's kind of a more scientific version of this. But when the market's at a high, people are very optimistic, enthusiastic, and everybody's wanting to buy in. They're worried about missing out. And then
Right.
when it's low, everybody's scared. There's anxiety. They don't want to do this anymore, and they're selling out, and basically repeat that process till broke. But yeah, there is a point of maximum financial FOMO and fear of missing out. And then there's a point of maximum fear and everybody gets out. And human nature, psychology, is we do the wrong thing at the wrong time. There is another saying, not a little bit crude here, but when there's blood in the streets, there's money in real estate. And the same sort of true in the market is that when everybody else is panicking, that's when the savvy investors move in. That's where people who know that their life is not affected by down markets move in to buy things on sale and seize on opportunity.
Right. That was Rothschild. Blood in the streets, good time to invest.
Yep.
All right. And the last sign is you feel pressure to chase returns. Again, what you were saying, these are all related. FOMO,
fear of missing out. And we've seen and heard some big names making big waves and big headlines. And after you hear about it, usually the wave has already crested.
Right.
It's peaked, or it's at least near it. And I feel like I'm throwing out famous investor sayings today, but another one is pigs get fed, hogs get slaughtered.
That's my favorite, Peter.
And it sort of is the theme of that is that if we are not in it for the building, if we just get in at the end, or if we try to maximize every bit of return and wait till this thing is at its very top, then ultimately we probably are making a mistake and going to get wiped out. Capture a trend. The market moves up over time. Be part of the appreciation. Participate in the growth over time. But don't try to absolutely max out. Don't try to time the market. Don't try to sell at the peak and buy in at the bottom. You are never going to time it absolutely right to the day consistently. Participation and time in the market is much more important than time in the market. And the chart on the screen here shows several previous downturns that happened in 87, the dot-com bubble in 2000, the Great Recession in 2008, and then COVID in 2020. I've got a very famous story that I share sometimes of the investor with the worst luck ever. He chose to invest right at the peak of those previous highs every time, and then got scared to invest further. And at the end of the day, he still did very, very well, had a huge return because he didn't touch the money. He didn't liquidate it. So again, if you could set it up on autopilot, pick good funds that are broadly diversified across the market, maybe an index fund, and then just kind of put your blinders on for a number of years and continue the process of being an investor. That is one of the fundamental secrets of investment success.
Yeah, it's funny though, Peter, because I feel that most people know that, right? And you and I read the same financial stories back in April. We're recording here in late 2025. When the markets took a dive, I read story after story of people who were liquidating their retirement accounts because they said the same thing over and over again, which was, this time feels different, right?
Every time does. But that's part of human nature and emotion. It gets us.
Right.
You can't fight your own innate nature.
It's hard because we are humans.
Yeah.
So how can working with a financial advisor help us be in line with our risk tolerance and kind of follow the plan?
Well, I think that there's a bit of discipline there that will benefit, accountability, but most importantly, maybe sticking to a plan, right? Is that if we have set this up and set out on a path and we've got a plan in place, yes, we're going to see volatility. We're going to see market movement along the way. But if we can make sure to stick to this plan long term and hold accountable to that, then ultimately we should be better off than making knee-jerk reactions on day-to-day movements of the market. And I think that working with an advisor, we can set that plan up. We can make sure that what risk you are taking are in alignment with the risks you're comfortable taking and that are appropriate to take, and then continue to monitor and update that along the way. Literally transferring that stress, that weight, that emotion onto someone else's shoulders, and adding to that a little bit more accountability and discipline to stick to a plan.
Right. And to hear again, this plan is backed by data and history and not driven by the headlines.
Yeah. People worry when the market goes down, but
Yeah.
given enough time, and the time is what should dictate the risk that you are taking, but given enough time, the market has not only always come back, it has always surpassed previous highs.
Right.
So it's a matter of, can you afford volatility in the short term to enjoy the benefits of the gains that will happen over the long term?
Right. And it's not to say though that, hey, gut it out, it doesn't matter. Like what we're talking about today, Peter, of course, being in line with your risk tolerance. So if what you want, what you work with your clients on day after day is, how are they sleeping at night, right? It doesn't mean you have to take on too much risk to get all those gains. It means that you're comfortable and at peace and can stick with that plan.
Yeah. The first 2 points. Are you checking your account balances daily? Are you getting good sleep at night? Like if you don't have a solid plan, those two things may be affecting your life. Like the enjoyment that you should be having living is literally being affected by your money and something completely out of your control in the market. And that's why we strive to help our clients optimize their plan from 5 critical different angles. But the investments and the investment risk is what we're talking about here today. Optimizing that investment plan, getting reasonable rates of return, but also within a range and comfort level that you can live your life and enjoy it, knowing that your money's doing what it should do. That's the goal of having an optimized investment portfolio and what we set up for our clients.
And how can people get that with you, Peter?
Yeah, give us a call. We'll have a conversation, start that process, and look at income, investments, taxes, healthcare, legacy. Those are the 5 critical pillars that are all interconnected, all load bearing for the support of your life and quality of life and financial confidence. We call it the Optimized Retirement Plan. And give us a call to have a conversation and get that process started. 919-300-5886, 919-300-5886, or go online to RichonPlanning.com. That looks like richonplanning.com. It's my last name, RichonPlanning.com.
Great. Peter, thank you.
Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. One of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.